Let me prepare you for GRE's National Home Price Appreciation Forecast for next year. Yes, today you're going to get an exact forecast number to the percent. Hi, I'm Keith Weinhold. This is Get Rich Education. Well, first things first. How well have past predictions performed? These are set in stone before the forecast year begins. Now, back in late 2021, recall that we just had come off a year where national home prices were up 20%, and some predicted that home prices would fall or even crash after that in 2022. But I let you know in late 2021 that home prices would rise 9 to 10% for 2022. I think it's likely that home price appreciation will continue, but the rate of appreciation will slow down. And the result was 10%. And then late last year, you had a few more agencies and pundits predict that prices would fall. I said that I didn't see how with such low housing supply. So late last year, I forecast 0% for this year. No gain, no loss, and it's too early to know that result yet. The year isn't done, and understand that my forecast is always made near the end of the year prior to the year being forecast, and unlike a lot of agencies, we don't revise our forecast. All right, so let's build some context here as I make the reveal, the forecast for next year. And this is harder to do than you might think because a lot can change in 12 months, from wars to a recession to an election. Well, let's look. What are other agencies forecasting for next year? At last check, the MBA says home prices will rise 4%, Fannie Mae 3%, Freddie Mac 3%, the HPES, that's the Home Price Expectation Survey, 2%, Goldman Sachs also 2%, the NAR says 1%, Zillow 0%, and Realtor.com minus 2%. If you average those, you get a forecast of about 1.5% appreciation for next year. Okay, that's them. And as we lead up to me revealing our forecast number here, I'll tell you that it's not that close to that 1.5% average from those agencies. And by the way, you should understand that none of those figures, nor will mine, be inflation adjusted. So everyone is using nominal prices. That's what the industry does. How is housing supply looking? Well, with the Fred active listing count data that I usually use, where the normal supply is 1.5 million units or more, we can see that the current amount is about 750,000. So it has rebounded somewhat, but yeah, it's still half or less of what is normal and necessary. And this dearth of supply, it supports more upward prices. You've got existing homeowners. Now, those existing homeowners, they're an important part of the market. They're locked into low payments and they have lots of protective equity, and the foreclosure rate is low. So no signs of distress there that could trickle out into the market and create a down drain. Let's look at interest rates. In recent developments from the last Fed meeting, that saw Jerome Powell show that he does not plan to keep jacking up rates. They've even got a timetable for when they might lower rates. Everyone wants to talk about how far rates are going to fall over the next year. It seems like that is the popular conversation to have. But here's the thing to remember. Like I've discussed before, mortgage rates hardly matter when it comes to home prices. Yeah, contrary to popular belief, they just don't have a lot to do with each other. And I've discussed why that is a few times before in the last year. So I'm not going to get into all of that again. But I mean, sheesh, you don't have to look any further than the last few years. Mortgage rates tripled and prices rose anyway. And the short story on why that happens over and over again with rising rates, you typically have rising prices. That's because when rates rise, yes, it hurts affordability, and that matters, but rates rise when the Fed is trying to cool a hot economy, and that hot economy is exactly what helps propel prices. Oppositely, when rates fall, it helps affordability, but unemployment tends to be higher and we might be in a recession, which constrains upward prices despite those lower rates. Now, if mortgage rates drop from, say, 7% to 6%, a scenario like that, what's still not that attractive for all those homeowners locked in at a sub-4 rate to go and sell because they need to find a replacement home at a higher rate. But yet if rates do fall to 6%, you will have a larger buyer pool because more people can qualify to buy a home. Looking at the economy, jobs are still being added, but a lot of them are part-time jobs. GDP growth is still fairly strong. Unemployment is under 4%, CPI inflation is near 3%. I'm not going to be full speed ahead with a huge number for next year's appreciation rate though, because the economy, it still has a pretty substantial chance of slowing down, as all of the past rate increases, they have this lag effect that can show and catch up with us, but I don't see that breaking the economy. And here is another indicator. When you look at future prices, Fannie, Freddie, and FHA, they all announced higher conforming loan limits for 2024, and that's because they expect more home price appreciation, and I do too. So as everything that I discuss and more has been weighed and analyzed and sprinkling in the spice of my experience as a direct real estate investor, I am happy to report to you here that my expected home price appreciation rate for next year is 4%. Yes, a pretty historically normal 4% next year, as the forecast for the previous couple years saw more anomalous numbers. And of course, what would that mean to you? Like, what's that really mean to you as the savvy, leveraged investor? Well, it means if you make a 25% down payment on a property, then you're leveraged 4 to 1. So you'd then expect a 16% return on your invested capital. 4% times 4 to 1 leverage. And of course, that is only one of up to 5 ways that you're paid simultaneously. I'm happy to provide you with a forecast. If you're interested in real estate and investing and you haven't yet, like and subscribe to the channel here. I'm Keith Weinhold. I'll see you in the next video. You can watch this one next.